Hello and welcome everybody to this meeting. Welcome to Luana Lewis, my counterpart at the New York City Better Business Bureau. My name is Sean Van Gorder. I'm with the BBB Wise Giving Alliance. We're here today to talk about the standards for charity accountability.
And I'm Luana Lewis. I'm the Senior Vice President of Programs and Services from the Metro New York Better Business Bureau. Pardon my cell phone, I'm happy to call it.
All right. We've already introduced ourselves. Let's get started with just a summary, a little bit about the Standards for Charity Accountability and some basic information about the BBB and the BBB Wise Giving Alliance and our charity reporting activities. The standards were initially developed by a national panel of experts around 2000, 2001. And at that time, we did research about donor information needs, what charities, what donors look for in charities that they want to give to, that kind of information. And with that large group of that national panel, we developed the current 20 standards, which cover key practices, including governance and oversight, finances, measuring effectiveness, and fundraising and informational materials. So those are sort of the core 4 parts of the 20 standards themselves. But in addition to that, we had some additional recommended practices that went into the sort of preamble of the standards. And they included sort of a commitment to diversity and pluralism, adherence to the law by the organization, and also the prioritization of openness and ethical behavior by the charity. Oops, there we go. Some of the core guiding concepts of behind the BBB standards, primarily, first of all, is voluntary disclosure. We rely on the charity's participation in the process. The charity provides us with the information that we need to produce our reports. We don't go out to third-party sources to seek information. We rely on that communication with the charities during the process. We also have a commitment to accuracy of reporting and solicitations. Donors must not be misled, and there should be clarity about how a charity is going to use the donations that they're raising from donors. We also look at duties of care, loyalty, and obedience, particularly with the board of directors. So we look for active oversight of financials and other aspects of the organization, as well as acting in the nonprofit's best interest in general. We also look for, again, compliance with law and policies. The board of directors is involved with making sure that the charity is following the law in what it does. And then focusing on achieving the nonprofit's mission. Of course, that's the key difference between a business and a nonprofit is the mission focus, and that's what we're looking for with the charities. And then some more guiding concepts. We are not rating the charities that we evaluate against each other. There's not a star or letter grade system that we're using. It's really just evaluating whether each charity meets our key practices. So it's sort of either you meet the standards or you don't, rather than a grading scale. We have a focus on generally accepted accounting principles when it comes to finances. That is sort of the gold standard that we use as far as finding information, looking at audited financial statements in particular, making sure that the charity is following GAAP or generally accepted accounting principles. Our preference in doing an evaluation is always to use an audited financial statement if one is available. We prefer that over the 990. It's not always sufficient to use the 990. However, for smaller organizations that aren't required to do an audit, we can use the 990 for our reporting purposes. And finally, our position really is that accountability is about more than just financials. Everybody thinks of finances when they think of a monitoring organization reporting on charities, and we do that. However, we also look at all of these other aspects of the organization because we believe they're just as important. So what is the benefit to donors for participating in for the work that we do? We make BBB reports, all of the charity reports that we produce, available for free on our website. So you can go to give.org to find all of the charity reports. It's a free, quick way to check if charities meet the standards. And also, donors know to look for the charity seal. So they can find it in the charity's appeals, they can find it on their website or other materials. And that's sort of a flag to show, without having to look it up on our website, they know that the charity is an accredited one. As far as the benefit to charities, the standards themselves are helpful key practices. Even if you're not evaluated, I encourage you to look over our 20 standards and look through the implementation guidance on our website to look at how your organization lives up to those standards. And perhaps there's ways that you can improve even without participating in our process. Of course, participating in our process helps us be able to guide you through that point to from not meeting the standard to becoming an organization that meets standards. So that's also obviously an option that I encourage you to do. But a first step might be to go to our website to look at the standards as well. Um, BBB accreditation is available. Any organization that meets all 20 of our standards, that goes through the process and has a report produced, is considered an accredited charity automatically. And that process is completely free. There's no fee to access our system, to submit information, to be evaluated, or have a report produced. All of that is free to the organization. And you would have a report on our website that says that you are accredited if you meet all the standards. The BBB seal, as I mentioned before, that's sort of an add-on product. Once you become an accredited charity and meet all of our 20 standards, you have the option to sign up for the charity seal and include it in your materials. That does involve an annual license fee and a license agreement that needs to be signed. Each BBB, whichever entity is producing the report with you, they determine what the fee scale will be. It's generally a sliding scale based on your contributions revenue. And here we have just a sample of an accredited charity report, sort of what it looks like live on our website. There's the accredited charity at the top, and there's some basic information, contact information, and then we list all 20 standards to show which ones are met and which ones are not met. And then we have some basic summary information about our conclusions, about your mission and your programs. We have a paragraph description of what your organization does, a summary of governance information, fundraising methods, specifics about your tax status. And then, of course, we have the financial summary. This is based, as I mentioned, if we have an audited financial statement, it will be based on information from that. Or if you only have a 990 or a 990EZ, we will use that instead. As far as who is eligible to participate with us, there are some eligibility requirements. First is that we look for your organization. We really only evaluate 501c3 and 501c19 organizations. The other 501c types, our standards really don't fit with. The other criteria is that the charities have to be receiving contributions and grants. If the organization primarily or only gets its funding from program service fees, that type of organization would not be eligible for a report. And then finally, we look for charities that solicit the general public and not just a specific group of people. So for example, if they're only soliciting alumni or you're only soliciting your parishioners at a church, those organizations are not eligible. We really are only eligible or only evaluating groups that have the broader scope of donors. Specifically, groups that we don't report on, colleges and universities, again, because they primarily solicit alumni only. Private and community foundations, we don't evaluate just sort of because of the nature of those organizations. The standards don't really fit with. However, I will mention that this doesn't refer to federated organizations like United Ways that have member charities that they fundraise on behalf of. Those organizations are eligible for reporting. Hospitals in general are not eligible unless their primary source of revenue is fundraising and contributions from the public. So if you think of sort of a St. Jude type organization that's primarily getting donations, they are eligible, but your local hospital system is likely not going to be eligible. 501c4s and other 501c types are not eligible. And then, as I mentioned, places of worship are generally not eligible. We can evaluate churches. However, if you're only soliciting just your parishioners, passing the collection plate, so to speak, it would not be eligible for a review unless you're soliciting the public at large. All right, so let's go ahead and
Okay.
get into the standards. Go ahead.
Yeah. Beginning with standard one, uh, just checking, Sean, am I coming through okay?
Yes.
Yes, great. Uh, so this is, they're all important, but a particularly important standard requiring that the board of directors adequately oversee the charity's operations. And there are a lot of aspects to this. And the list that we have here are examples that are important that we'll check for. But I would say also that they're not the only things that would fall under the rubric of governance, good governance. But they are things that we specifically look for. We want to see that your board is formally approving your budget every year. You should have a monitored conflict of interest policy. And in some states like New York, there are legal requirements. So you want to make sure that you know what those requirements are and come into compliance with them. And that you are abiding by whatever the terms of your conflict of interest policy are. Often there are very specific procedures to follow when there are state regulations. And it's good to know about those because they're good practices to follow, not just good practices for regulatory purposes. Your board should be reviewing if you are hiring, say, an outside vendor to conduct fundraising for you, or a fundraising consultant, or you're engaging in an agreement that involves a lot of expenses or potentially a cause marketing agreement. Those contracts should be available to your board in terms of they should be overseeing it, they should be aware of it and understand what the key aspects of it are. That doesn't mean that every single purchase has to be reviewed by your board, but they do need to be familiar with major contractual agreements that you're engaging in on behalf of the organization. There needs to be a voting board member who oversees the finances. Usually this is a treasurer, should be a non-staff person. It doesn't have to have the title of treasurer. Doesn't have to be someone who is deeply experienced in fundraising, but it does, in financial management, but it does need to be someone who has good judgment and can oversee this independently at the board level, apart from the staff and apart from the chair. The chair should not be the treasurer. Some of these requirements are about separation of powers, so there's always someone overlooking important issues apart from people who might have a conflict of interest in those particular issues, financial especially. Your board should receive and review your annual 990 if you're required to file one. Most charities are, although if it's a religious institution, you may not have a 990. And financial statements, your audited financial statement and the management letter. Your CEO should have a performance review every 2 years with your board or an executive committee of your board to ensure that that individual is overseen by the board. That doesn't have to be adversarial. I know sometimes that's a perception about performance reviews. Often it's very collegial, and it can be about how can the board help the CEO carry out the mission of the organization. But the board is tasked with hiring and firing the CEO, executive director, or other most senior officer of the organization. That is one of its very key functions. So you do need to review from time to time. 2 years is a reasonable period, how that individual is doing. The board and the CEO are charged with complying with applicable government regulations, which means you need to be familiar with them. And yes, attorneys general will hold organizations and their boards of directors accountable if they fail to comply with the law. So those are examples, but there might be other ones that would arise that could fall into the governance bucket. But these are really good ones as fundamental basics to make sure you're checking those boxes. Next slide. Quick and dirty, your board of directors should have at least 5 voting members. Some states require fewer. New York State requires only 3. But our thought is that you need at least 5 to ensure diversity of thought and good governance. Next slide. So board meetings, oddly during the pandemic, even though it was possible for people to meet on channels like Zoom or Teams or GoToMeeting or Google Meeting, and we allow that if board members can both see and hear each other. We call that a face-to-face meeting. There should be at least 3 evenly spaced full board meetings with a majority of your board in attendance. If you have more board meetings than that, we'll look at the 3 that have the highest attendance. You can even have 1 phone conference call allowed out of these 3 board meetings, but governance doesn't happen if the board isn't meeting and reviewing what's happening with the organization and discussing it with the organization staff. And it should be spaced out through the year so that governance is happening throughout the year and not kind of lumped at one end. Strangely, sometimes this hasn't happened. It was odd that it occurred during the pandemic, but perhaps that will change now that we're moving away from the pandemic. But a few people recognize that you can count 1 phone conference call and any face-to-face meeting that is a video conference meeting online will also count. So board compensation, there should not be more than 1 person or 10% of the members of your board, and that's the voting members, whichever is greater, who are either directly or indirectly compensated. Now, what is indirect compensation? It may be that you receive a benefit that has monetary value, which is not money, or that someone very close to you, like a close relative, receives a benefit that has monetary value. The use of an apartment or a car or an insurance policy might be examples of an indirect benefit. But the idea is that the board should be disinterested parties who don't have conflicts of interest and are not interested in receiving income from the organization themselves or for their families or closely affiliated people. In addition, compensated persons should not be your board chair or treasurer, and this is sometimes an issue with treasurers. You will find with some very large organizations that the board wants the staff treasurer to be a board member. The solution to this is to make that person non-voting. They can be present, they can provide information, they can advise the board, but they should not be a voting member of the board to avoid a conflict of interest situation. Also, the chair should not be someone who is performing the role of CEO or chief operating officer. That might be the case in an organization that has basically it's a volunteer-driven organization and there's no staff. When that happens, it's a really good practice for the board to divide up the duties so that they're not concentrated in a single person, and you maintain a differentiation. You have like a separation of powers. It's not all the same person doing everything. And that can be a problem in all volunteer-run organizations. Next slide. So I think we actually just covered that, so we can move on. So Standard 5, related party transactions. Very important. Regulators are quite interested in this. There should not be any transactions in which any board or staff member have material conflicting interests with a charity that result from a relationship or business affiliation. So what does that mean really? It's not that there can never be a potential conflict of interest, but it shouldn't be material, meaning it shouldn't be so egregious, so important that it impairs a board member's or a staff member's ability to act in the best interest of the charity. And then you want to have processes in place that will help to prevent conflict of interest being an issue for your organization. That would include whether or not the interested party, the person with potential conflict of interest, actually participated in a board vote on something that would benefit him or her. Potentially, if that person even took steps to influence the board on a vote, whether or not competitive bids were sought, the size and duration of the transaction, and whether or not the transaction is a one-time event or if it's ongoing. All of those factors might weigh with us, and I will say that our judgment is separate from the judgment of the Internal Revenue Service and your state regulators, and those folks may also have opinions about what constitutes a related party transaction and conflict of interest. So with the IRS, and you can go to irs.gov and check this out, but they want to make sure that there isn't anybody who is inuring a benefit to the detriment of a charity. They don't want that to happen because the charity is a tax-exempt entity that is not supposed to be benefiting private parties. Likewise, your state might have requirements that you need to satisfy in this area. So you do want to check on those and make sure that you are in compliance with the law there. Next slide. So Standard 6, along with its companion Standard 7, are frequently missed, and I think it's not because charities aren't following these practices, but because they don't realize that they are, or they may fall slightly short of what we look for. What we're looking for is for organizations that are tax-exempt charities to, at least once every 2 years, in concert with their board, have both a board policy of assessing their impact against their mission and develop a written report that reports to the board for their approval on their progress against their impact against the mission. So it's not just programs, and sometimes there's confusion about well, do I have to do a program impact evaluation? That can be very, very expensive. And that's not really what we're talking about. We're saying take a more holistic look at your organization and everything you are doing to meet your mission. What worked, what didn't work, what could you do better? So having a board policy is pretty simple, but the board does have, it could be embedded in your bylaws, but you do need to have something in writing that your board has approved, committing the organization to do that. Next slide. So what we're looking for especially are measurable goals, a process to evaluate this, but we don't need to see your evaluation. That's yours. We're not going to judge your evaluation. We just want to know that it happens. Next slide. So the written report actually, more often than not, could be the same thing as your strategic plan if it assesses your progress against your mission goals, the specific things, your strategies and tactics that you are using to meet your mission, and makes recommendations for future actions. So if you were doing that in your strategic plan at least once every 2 years, in writing for your board's approval, that will meet this standard. And in writing for your board's approval could be anything in writing for your board's approval, but it does need to be in writing. Next slide. I'll just point at something that was developed some years ago by the Wise Giving Alliance with several other organizations collaborating, including what's now Candid, I believe, right? This was quite a project, and they boiled down the whole issue of how do we figure out where we are in our mission path to 5 really simple questions, and it was tested by both very large and small organizations. What is your organization aiming to accomplish? What's your mission? What are your strategies for making this happen? How are you going to achieve your mission? What are your organization's capabilities for doing this? Do you have everything you need to achieve that mission? If not, what else could you need? And how are you going to get it? How will your organization know if you are making progress? How do you measure your impact against your mission? Could be simple, could be complex. And finally, what have you and have you not accomplished so far? So where are you in the journey? Um, the answers can be simple or complex, but if you answer these questions on your board, sees that and approves that, that satisfies standard 7. Next, over to you, Sean.
All right. Yes. So getting into the next section of the standards, which is the financial standards. Standards 8, 9, and 10 actually are the only 3 standards that have the spending ratios that I mentioned before that a lot of people think of when they think of charity monitoring organizations. Um, and before we get into that, I want to talk a little bit about a project that we were involved with at the Wise Giving Alliance a few years ago. Our CEO, Art Taylor, along with the CEOs at the time of GuideStar and Charity Navigator, signed 2 letters, one to the Donors of America and one to the Nonprofits of America, talking about what we called the overhead myth. Um, and just as a side note, this what I'm about to talk about is still topical today. Even as of last year, we're still talking about the overhead myth and the impact of ratios on the way people consider charities they want to donate to. But the key points to the overhead myth were that by itself, the overhead ratio, the fundraising percentage or the program percentage, is not a good indicator of nonprofit performance. It's important to know that there are other factors that are just as important, such as transparency, governance, leadership, and results or impact reporting. But I will say that again, we're not saying that overhead ratios are not important. We're just saying that it's one part of the whole when you're considering an organization you want to give to. So charities should still keep overhead spending reasonable and should keep their fundraising and administrative costs in proportion to their program costs. Um, why is this important today? Well, a lot of organizations want to keep an eye on how they compare to others within their types of organization, their competitors. We will say that most charities that we evaluate meet these standards that we have, standards 8, 9, and 10. So it's more common to meet these standards than not. And also, just the other reason to keep an eye on it is because media, government, and donors, even despite the overhead myth letter, are still very concerned with these percentage ratios. It's sort of the quick way for them to look at an organization. So again, it's important for you to keep an eye on as your organization changes over the years. So when it comes to our standards, the first one, standard 8, is looking at the program expense ratio. So it says that program expenses should be 65% or more of total expenses. So the way that we calculate it is we take the total program expense divided by your total expense, and it should be at least 65%. And just as a note, what we take this sort of the gap definition of program expenses, so it would be any cost that is associated with fulfilling your organization's mission, as opposed to fundraising or administrative expenses. We have recently seen issues with misunderstandings about what is or is not a program expense. Again, we follow that gap definition. There has been unclear or inaccurate reporting, including lack of clarity about fundraising affiliate relationships. So if you have an organization you're raising money on behalf of others, it's important to make sure that you're correctly allocating costs that are programmatic versus actual fundraising costs for your organization to bring in donations. You have to make sure you're keeping track of those 2 things. Standard 9 is the fundraising expense ratio. It says that the organization should spend 35% or less of related contributions on fundraising. And another way to think of this is the cost to raise $1. A lot of charities will use that figure. It's basically your total fundraising expenses. I'm sorry, I didn't move it forward. It's basically total fundraising expenses divided by total related contributions. So when we're looking at this, we're not looking at it as a percentage of your overall expenses. We're looking at it as an overall amount of the amount you brought in as a result of fundraising. So, and some examples of what we call related contributions are, of course, donations from individuals, private or corporate donations, in kind or basically stuff that you get donated, clothes, books, things like that, special event revenue, bequests, government grants, although if it is a more of a fee for service type of relationship, a contract, we would not consider that. We're really looking at straight up grants from the government, and also membership dues. If the benefit of being a member is not very high, so if you consider your donors to be members and if you consider that to be a membership fee, that would be considered a related contribution. So these are all
If
things
I
that
could
we would
just
add on.
insert one quick comment.
Sure.
In audited financial statements, we often see government grants and contracts kind of lumped together, which makes it hard for us to figure out what your true contributions total is. And especially if your government grants are big, it can really matter. So it's helpful if you separate that out in your financial statements, even in just a note, or let us know what the breakout is so that we can calculate it correctly.
Right. All right. So then standard 10 is the final ratio standard. And it's dealing with accumulation of unrestricted net assets or assets that are available for use. So they should avoid accumulating funds that could be used for current program activities. The reason behind this standard is that when we were doing research into what donors are looking for in a charity that they want to give to, one of the things that kept coming up for us was that donors want to know that there is an immediate need for their donation. So organizations that are raising money, but then keeping large and growing these large unrestricted endowments or investments, um, it's you're taking donor dollars, but you don't have that immediate need that donors were looking for. So what we said was, in order to meet the standard, unrestricted assets that are available for use should not exceed either 3 times of last year's expenses or 3 times of the current year's budget. So another way to think of it might be if your organization stopped fundraising altogether today, would you be able to exist and continue maintain your organization for more than 3 years? If so, then you wouldn't meet the standard. So I will note that when we're calculating this, some organizations might own the property that they're on or other large volumes of inventory. We do subtract your fixed assets, your land, building, and equipment from your unrestricted assets when we calculate this. So if you own your building, it's not going to impact you quite as much. If an organization is over that 3 times limit, there is a way for them to meet the standard if they are willing to include a statement in all of their direct mail appeals and on their website that explains to the donor what their financial position is as far as unrestricted assets, then we can amend the finding once they agree to do that and show us samples of what it's going to look like. I'll also mention that when we're looking at unrestricted funds, board restricted, either endowments or just board restricted donations or funds are considered unrestricted assets. We only consider, we follow the gap guidance. We only consider something to be temporarily restricted if the restriction was made by the donor at the time they made the donation.
Well, I think they call it donor restricted now, right? Temporary restricted is over in GAAP.
I'm still seeing it now, but yeah, but I
Yeah,
think they
from
might
from
separate
the
it. Yeah,
older statement. Mm-hmm.
yeah. All right. So standard 11 is, again, we're moving past the ratios and now we're looking at the organization's reporting, financial reporting. So an organization should make available to all on request complete annual financial statements prepared in accordance with GAAP, generally accepted accounting principles. Now we do have the overall national standard, which is part of which is standard 11. If your organization is bringing in over a million or more in income every year, then you need to have a CPA audited financial statement. If your organization brought in between 250,000 and $1 million, then we would look for a CPA review, which is sort of like an audit audit light. It's not quite as involved as an audit. And then below that, if your organization is under 250,000 in revenue, an internally prepared statement or the IRS Form 990 would be sufficient to meet the standard. The standard, though, we do recommend that you check the applicable state law in any state that your organization registers to fundraise in, because some states might have more stringent requirements than our standards go. And in order to meet the standards, you need to make sure you're following your state's laws and regulations. So, or the states that you're fundraising in for national charities.
And if there is an audit at a lower level, it's the audit we want to see.
Yes, if you're producing an audit, we want to see your audit because it's just a better picture of your organization's finances than the 990. Standard 12 is looking for the detailed functional breakdown of expenses in the audit in the financial statements. So include in financial statements the breakdown of expenses. It should show a column for program expenses. And if your organization has multiple major program categories, you should have a breakdown for each of those programs. We look for a column with fundraising or development expenses, and then an administrative or M&G column as well. So just a sample of what we're talking about here. You can see an organization, you have program A, program B, fundraising, and admin or M&G. This actually is, well, I think it's on the next slide, but so financial statements should include a breakdown of expenses that show the amounts allocated. So you see the rows are the different categories of expenses, and the columns are the programs and fundraising and admin. Why is
Oh,
this important?
before you move on, if you could just go back to the prior slide for 2 seconds.
Sure.
I just wanted to comment that often expenses like salaries, travel, and postage might be stereotyped as overhead expenses when, if you can reasonably document that they apply to a program, they could be program expenses. So you want to make sure that your allocations fairly allot what you are actually spending on your program. And that is a common misconception that we often see.
So why is this important? Why would you include this? Well, it is a critical management tool for staff and board, and it really tells the story of your organization's expenses and what you're spending your money on. Um, Also, I think FASB agreed with us. It used to only be a requirement in the audit for certain types of nonprofits, but now it is a requirement for all nonprofit organizations that have an audit to include a detailed functional. I think the only thing it doesn't require as much as we do is the multiple program categories. If you have multiple programs, for us, we look for it to be broken out by major program category. Also, if you're wondering how you go about doing this, it's actually built into the 990, so your accountants are probably already doing it in order to fill out the 990 every year. Page 10 of the 990 has this detailed functional in it. All right. Standard 13 is getting at the accuracy of your financial reporting. We say that the organization should accurately report their expenses, including any joint cost allocations. I'm not going to get deep into joint cost allocations here. It's primarily something that larger national charities do with their direct mail. We could do an entire hour just on joint costs, but I will mention that for joint cost allocation, we look for you to follow the accounting guidance from the AICPA 98 Statement of Position 98-2. But when it comes to reporting, accurately reporting expenses, some of the things that we look at is the organization incorrectly claiming zero fundraising expenses? This is something we see commonly with smaller organizations in particular, where they may not be recognizing some of their salaries or occupancy and common expenses that should be allocated amongst all three categories may not be adequately allocated. So that's really what we're talking about when we're talking about accuracy and looking at zero fundraising expenses. There can also be some confusion around the special event revenue. There is an accounting rule that allows you to net the cost of direct benefit to donors from a special event. So maybe like the cost of a meal or renting a location, you can actually net it out of the revenue rather than reporting it as an expense in your state financial statements. Some organizations take advantage of this or mistakenly allocate the fundraising portion of this, which is sending out invitations and advertising the event. All of those are not allowed to be netted out of revenue. They have to be displayed as a fundraising expense in your financial statements. There's also some unclear reporting about governance relationships with affiliates. We talked about this a little bit earlier about organizations that fundraise on behalf of others. Just important to make sure that you're accurately allocating the expenses in the right way in that situation.
And just commenting
And
about
then,
that, Sean, and this is a
okay,
question for you. Um, we have been seeing a number of organizations that have affiliated but separately incorporated organizations fundraising for them, where basically the only mission of the affiliate is to fundraise for its associated charity.
mhm.
And I would expect to see that in the financial statements, wouldn't you? As an in-kind donation, and then as an expense as well. Thoughts? Mm-hmm.
Well, if are you referring to something like a United Way that's raising money on behalf of other organizations, or and then
No, where, like, say, the entire operation of an affiliate is to conduct, or maybe a large part of what it does is to conduct fundraising for an affiliated organization, and that's actually a donated service for its
right?
associated charity.
So the transferring of money to the affiliate would be a program expense, right? Because you're
Right.
granting money
Mhm.
to the affiliate organization. Is that? I think that's what you mean, right?
Well, I mean, actually, with the affiliated organization that's receiving the fundraising and noting
Right.
that as a donated
Yes.
in-kind service,
Yes. The affiliate
because
organization.
sometimes that happens and I don't see it in the financial statements. Mm-hmm.
Yeah, well, there are certain situations where it's considered a quote unquote pass through. It depends on the relationship between the
Mm-hmm.
two entities. If it's considered a pass through, then it might not be allocated in the financial statements. If the organizations are so separate that they have separate audited financial statements, then yes,
Mm-hmm.
it would be an outgoing expense on one charity and an incoming revenue on the other one. If they're combined financial statements, they might not have that. They'll show the transfer of assets, but they won't necessarily show it as revenue and expenses. It depends on
I know it sounds
depends
wonky,
on the
but it
relationship.
comes up fairly often.
Yeah, yeah. It depends on how closely related the two organizations are. Yeah.
Mm-hmm.
All right. So we'll get on to standard 14, which is the budget standard. We look for every organization to have a budget. It must be approved by the board of directors, and it must contain certain projected expenses. At a minimum, it has to have total program expenses, total fundraising expenses, and total administrative or M&G expenses. And again, if you have multiple major programs, you should break it out for each of your major programs. That's sort of the bare minimum of what we're looking for. So an example here, you'll see this is what would be more of a line item budget that just lists the common expenses as line items and then has the total at the bottom. This is not what we're talking about, and this alone would not meet the standard. However, let's say you had this and then you had another page on the budget that looked like this, that has the functional expense breakdown for your budget. And so you see your projected income items, then you have your projected program expenses broken out by your major categories, and then you have your projected fundraising and projected admin expenses. So this page here is sort of the absolute minimum of what we would look for in order to meet the standard, is having these totals somewhere. We're not going to, if you don't meet the standard and you're trying to fix it and amend the findings, we don't need you to completely redo the format of your budget. I know your board and your staff will have a preferred budget layout, and we're not trying to get in the way of that. We're just saying if you could add something like this to your budget so that the board members and people reviewing your budget are able to see what the projected expense breakdown is. That's really what the point of the standard is, to make sure that this information is getting to the board and that they're keeping an eye on the ratios and the expense categories. If you're new to budgeting, there is a tool. If you go to strongnonprofits.org, it's there's a tool to help you, a toolkit to help you in setting up your first budget, working through it. Recommend taking a look at that if it's again if it's something that you're completely new to.
Okay, so let's dive into the fundraising standards. The relationship between donors and charities is a key reason why we do charity reporting. So standard 15, moving on to the next slide, is really kind of the core of the purpose behind all of the BBB standards for charity accountability. It says that all solicitations and informational materials, that whatever your communications are, now that's all over the place, right, that are distributed by any means, digital now, all kinds of ways, be accurate, truthful, and not misleading, both in whole or in part. The not misleading and in whole or in part aspects of this sometimes can be confusing for charities, but what we mean by not misleading is you don't want to withhold information or depict information in a way that could mislead the donor. So we look holistically at the representation, and just moving on to the next slide. What does that look like? Well, we want any stories or photos to be up to date and accurate and refer accurately to real things. If you have a picture of kids, it shouldn't be labeled, if you bought that from a stock photo house, as clients that your organization has served. And it may be that you have a really fabulous fundraising appeal that has produced amazingly for your organization, but if the stories and photos that are in it are completely out of date and don't represent your recent mission impact, then it could not be considered accurate for what you're doing now. Key facts about the donation should be disclosed and not withheld. So if there's anything important that a donor might need to know in order to make a donation decision and it's not disclosed, like how your donation is going to be used, how it's going to be applied. You want to be very careful about that language. Make sure that it's neither too broad, so that it's too vague, or too narrow, so that you can't apply it for all the anticipated uses. And that includes everything that the donor needs to know. Financial and success statistics. We see people, and this is a common issue in New York, using claims like 100% of your donation will go to support specific program X. And then they won't disclose why that's true, if it is true. So when we see something like that, we will ask for substantiation, some kind of documentation, or show me in your financial statements that that's true. Often the reason why it might be true is maybe your board or some special donors are making restricted gifts that are intended to cover all of your fundraising, management, and general expenses. If that's the case, you need to say that at the point of solicitation, and you need to be able to show it as well. Are your claims about your program success rate accurate? That isn't a common problem with us, but if it turns up that you're making some wild claims about the impact of your program, we might raise a skeptical eyebrow and ask you to substantiate that. And more than anything else, if you say you do something, be ready to show that you in fact do it. Moving on. So why? The most important thing that donors want to know is that they're intent. So we're looking for clarity, that you can substantiate claims, funds used for the purposes in the solicitation. It's not just us that will require that, your state regulator probably will too. And I think we went through the rest of it, so we can move on because we're short of time. Now, here's one that is often missed. As we have moved into a digital space with our communications, frequently I'll run across charities that aren't producing a traditional annual report. And we don't ask for a lot, but we do think that you should be explaining to donors how their donations are used in an annual report. It doesn't have to have that name. What it should have is your mission statement. What are you in business to do? What do you want to achieve? a summary of your past year's program results. How are you achieving that mission? And what were the results last year? A roster of your organization's officers and members of your board, and then basic financial information in terms of totals, not percentages, total income for the prior year with your expenses broken out functionally into totals for program, admin, and fundraising, and then your ending net assets. Now, little known secret, your 990, if it has all of those elements in it, might serve as an annual report if you make that available upon request when someone asks for an annual report. A video is not an annual report. It needs to be something that you can print of internet access. But it doesn't have to be glossy or expensive. The 990 is not exactly a user-friendly document, but it is possible to include all of the very basic elements in it that are part of what we look for in an annual report.
I'll just mention
An online
with
report.
oh,
I'm sorry, Sean. Yes.
I was just going to say, with using the 990 for the annual report, my recommendation would be that you include a cover letter that talks about your accomplishments, because everything else is going to be built into the 990, except that it's not very good at reporting accomplishments.
It can be if you put that in Schedule O of the 990. And I agree that that is an element where sometimes the 990 falls flat for the requirements. You might just have a line saying, here's what we do, but that isn't quite the same thing as reporting your program results. But you can do that, and you don't have to need a novel, but you can have a couple paragraphs in Schedule O, and that'll do it. So website details that can't be printed, like fancy online magazines or videos, don't meet the test, although they're wonderful and donors love them, but it's not quite the same thing. Next slide. So we're looking for you to disclose on your website, if you're soliciting by any means, that could be requesting mailed contributions or asking, by text for contributions, whatever it is. The information in your annual report should be there. Your mailing address should be there so that people know how to contact you. And then access to your most recent 990 that can be a download or a link to where it appears on Candid or potentially now on the IRS website. I think they've started to publish full 990s, right? That's a big change. So moving on. Privacy is a major concern of donors, and our standard calls for you to allow donors to opt out at least once a year in written appeals and also on the website. A good practice is to do that if you're soliciting through emails, like every single email, apart from the canned spam requirements, one of the most frequent complaints we get is, I can't get off this charity's list. Would you please make them stop contacting me? I don't want it anymore. Make that easy so that you don't anger a donor, because an angry donor will tell 20 other people how badly they were treated. Other things to include what information you're collecting, how it's going to be used, how to contact the charity to review and correct information, how to ask the charity not to share their personal information outside the organization, and what security measures are in place. And then for that, we're not asking you to, give all of the details. Simply say that you do have security measures and give a general idea of what they might be. Obviously, you don't want to explain in too much detail because cybersecurity is a problem. Moving on to the next slide. An opt-out for this can just be a checkoff. Next slide. This is not part of the standards, but we have some cybersecurity resources that we can suggest, and we will share slides after. Next slide. Very briefly about cause-related marketing. What is it? It's a commercial entity that claims that a charity will benefit from a consumer sale or transaction. And, the charity's identity is a monetizable asset that the board is charged with protecting. So the charity, it does have power to control that and should control that through agreements with your cause marketing partners that are commercial. Next slide. What are we looking for? We're looking for this full disclosure, just as we would with any other kind of purchase, of the who, what, when, where, and how. The actual or anticipated portion of the purchase, that can be a flat amount or a percentage, with terms like proceeds or profit, that's just much too vague. And we do see that a lot. Like, the net proceeds of this sale will benefit so-and-so charity. Means nothing. There might be no net proceeds, so then that's not a benefit to the charity. The duration of the campaign time frame, if there's no time frame, then it's a continuous offer. But if there's any time limitation, that should be mentioned, or any other limitation should be mentioned up front. We do see people missing this a lot, and then we do have to keep reminding. Next slide. So here's one example that passes. 5 cents will go to ABC Charity, a named charity, for every bottle of juice sold in July, up to a maximum of $500,000. So you've got the time frame, you've got exactly what the benefit to the charity is, you know that it's ABC Charity, and you know that there's a cap to the amount that the charity can earn. You do want to watch out for state requirements in this area. New York has some. If you're going to do this across state lines, my best advice is get competent legal counsel. It can get very complicated. And we do get complaints. We ask that charities respond promptly to complaints that we bring to you from people. If you're a human services charity, often they're about the services provided, or again, they're about solicitation. And we're coming up on our time. Sean, you want to just flip through this?
Yeah. Well,
I think
just in the yeah, I think just in the interest of time, I'll skip till the end.
Well, there are a couple of questions. One, could you address the submission deadline this year? I'm sorry if I missed it. This is submission deadlines are worked out individually between us and charities, but usually we expect prompt submissions. So that if you have, I'm not sure who is inquiring, but communicate with us with the contact information we have there, and we can work with you to make a reasonable time frame for your submission to be complete. Will these slides be available? Yes. Can I have a copy of the slides? You bet. Also, as a recording of this webinar going to be shared. Yes, so I just want to say thank you to everyone. We have 2 more minutes, so if there are any additional questions. Sean, during this time, do you want to just mention briefly about the seal, since we have a minute or 2?
Sure. Well, as we mentioned at the beginning, we have the charity seal as on offering. So every Better Business Bureau, regardless of which one you're working with, is going to be offering the charity seal to any charity that's been accredited. So you've gone through the process, you've met all 20 standards. It's available for use to put on your direct mail appeals, your website, your annual reports, documents that you produce. And the idea is that it's an easy way for donors to be able to just glance and see that your organization is accredited with the BBB. Obviously the Better Business Bureau is a recognizable trademark that people have trust in, and trust is our business, and we want to help donors be able to identify charities they can trust to make donations to. I think as we mentioned earlier, there is an annual fee associated with it and a license agreement. Reach out to the BBB that you're working with, or the Wise Giving Alliance if you're working with us, and we can give you the details on what our fee schedule is for our organization.
And there are charities that, once again, the process is free, being accredited is free, no cost. The seal is optional, but it's very handy for fundraising in today's really difficult fundraising climate. It can be a real asset to show donors instantly that your charity has met high standards of accountability. And we are at our time. I want to thank everyone for attending, and Sean, thank you. And thanks to Emmanuel, who has been behind the scenes running things. And thank you all for attending. So. with that, our program is concluded, and we welcome your contact at this information here. Thank you all.
Hey, everyone.